Here we go.
All right.
All right. Right. So first of all, Ramis Fakori here at the IRA Club, and I want to personally apologize for the inconvenience and the technical issues that we've had. When we switched over from GoToWebinar to Zoom, one of the features that we wanted to add on was a little bit more of a heavy security feature when it comes to jumping on and off Zoom webinars. Why? Because we deal with sensitive information. We're dealing with IRA funds, 401k funds, retirement funds, please forgive me. So these are US products, right? These are, there's no reason for somebody from, let's say, Europe to jump onto a Zoom call. Now, it's funny because Canada, it says when you join Zoom, Nathan, that Canada is okay. So I'm a little weary about that. Me and Xavier, gentleman, part of our IT team, had a little bit of an issue. So we want to, first and foremost, apologize for everybody who jumped on. This is a recording. Don't worry. I'm pretty sure already the majority of you have received a follow-up email with Nathan's contact information, my contact information, IRA Clubs, also earnestinvesting.com, his website. So please feel free. I know that you're not going to receive the recording right then and there. So this is just a follow-up. Now, Nathan, we always ask as a new sponsor on Investors Row, or newer sponsor on Investors Row, we always ask to do these educational webinars with leaders in their respective fields and people who I consider to be experts. And because there's one thing that we can't do here, Nathan, is choose the investment for the investor. So we do these great free educational webinars, the majority for IRA Club members. What I am going to do is jump and start sharing my screen, because something that I do want to offer to the people that may have registered on Facebook, Instagram, and or LinkedIn. Can you go ahead and see my PowerPoint? Start from the beginning. Can you see it,
there
Nathan?
It is. Yep.
There it is. So as I just mentioned real quickly, this is a webinar to learn more about lending within your IRA. In particular, Nathan's going to talk about mortgage note funds, if I'm not mistaken, Nathan. And
that's right.
And it's powered by Earnest Investing. This is his company. He is the founder and CEO, but we also have to get this disclaimer out of the way. Remember, because we do these for educational purposes only, a lot of people ask us what are the differences between IRA Club and, let's say, Fidelity, Vanguard, and Schwab. Remember, they are a trust company custodian. We are the same. The only difference is we cannot choose the investment for the investor, which means in turn, the only thing that you're allowed to do really with Fidelity, Vanguard, Schwab, and TD Ameritrade is stocks, bonds, mutual funds, and ETFs. We allow you to do that and invest in the alternative space. If you're listening to me say that again, I apologize if I sound like a broken record, but that is the reason why this disclaimer is there, is because we cannot perform legal, financial, or tax advice of any sorts. So when we talk about these educational webinars and bring on the respected experts in their fields, we want you also to do your due diligence. Reach out to your CPAs, lawyers, financial advisors, registered investment advisors, or anybody that you use before you jump into any type of investment opportunity. So the agenda today, real simply, is we're going to do a quick introduction, which I already explained who the IRA Club is. We're going to talk about what is note investing. My apologies as I scroll this up. How is note investing different from rental properties? How you can help someone else without lifting a single finger and make money while you sleep at 8% returns with investing, and then the process itself. But I also want to talk a little bit about prohibited transactions. For those that are joining us for the first time from Facebook, Instagram, LinkedIn, I would like for you to pull out your phones, simply turn on your camera, scan that QR code, because this is a great 5-minute quick guide to go over our topics, things that we discuss from opening funding and investing, and all of our contact information here at the IRA Club. If you would like to schedule a call, is on this quick guide, because I don't want to take up too much of Nathan's time. That is why we're here, is to learn from Nathan. Nathan, for those that are listening to the recording and not live, so we do apologize again, why don't you go ahead and tell us a little bit about yourself, buddy?
So this whole mess is my fault. I live in Canada.
It's okay.
I like paying taxes, I guess, but born and raised in Canada. But I've been doing this note investing thing for the last 10 years, all from Canada, all in the United States. And it's the banking systems are different just enough where there is no secondary market in Canada for these notes. So all of my investing, all of my business has been in the States for quite a while now. And I don't see that changing anytime soon. I really, really enjoy what I do.
Well, thank you. Honestly, that was quick, Nathan. Usually somebody wants to elaborate and talk for minutes upon, I mean, sometimes I have to like cut and intrude the guest speaker, but in your case, that was a perfect 30-second breakdown. But if anybody wants to learn intimately more about Nathan, please feel free to reach out to him. As I mentioned, all of our contact information will be popping up if you haven't already received it, right? If you've already received it. But one of the things that I talked about, Nathan, I wasn't sure if you were there to listen to the very beginning part right before we jumped on and did this recording, is investing has changed dramatically, especially with how volatile the markets are. Inflation is up. Everything is basically working against people's retirements. I know this CNBC shot out and the Washington Post shot out this article, basically the same breakdown and analysis that 401k administrators and people who have them with their current employer have been hit extremely hard since the beginning of this new year. In fact, I believe it's roughly close to 28% of their 401k funds have just disappeared. Wow. So why am I saying that? People are looking to pull their money out of the market and invest in the alternative space. That is the beauty of IRA Club and what we provide our members and anybody who just wants to learn about how to take control of their retirement funds. Because let me tell you something, the ultra wealthy, traditionally people in the 32% tax bracket or higher, which are really accredited investors, they don't only utilize their own personal funds in this manner, but they also utilize their retirement funds in this manner. And for me personally, the icing in the cake is why not grow your investments tax-free or tax-deferred? Now, with that being said, this gentleman, Carlos Lee, head of investments here at the IRA Club, him and his team have been working unbelievably hard. And I will tell you the reasons why is people are definitely, the word is getting out there, Nathan. I will tell you that now more than ever, and we're super excited about it because we spent the last 10 to 12 years just educating people on this opportunity, and finally people are learning about it. And the beauty of what it is that you do, you could lend, you don't have to be, but let me backtrack a second. You don't have to be a sophisticated investor or accredited investor anymore. This is also for non-accredited investors. You utilize your IRA or 401k as a bank, right? Why do they get all the benefits? Why can't you get the benefits of using a portion of your retirement to diversify and protect yourself against what is going on right now with the world around us? So this gentleman is the key to all of this. And I don't want to show you he's the key. He's the gatekeeper, as I like to call him, right? He processes anywhere on average about 250 investments a month. That number has definitely grown in the last 6 months because of where the market's at. And I think that it's going to continue to stay that way. I just think it's a little too late as the interest rates keep going up. I think the market's going to stay extremely volatile, at least for bare minimum the next 12 months. They have to figure out this whole inflation being at 8.56%, I believe right now. Everybody's feeling it. The household income right now, I believe month to month is paying an extra close to $400. So again, you know, the only way to really protect yourself against inflation is the alternative space. The reason why I bring this to your attention is 1 out of 3 investments right now at the IRA Club, lending seems to be a big factor. But there are rules to investing with your IRA. Prohibited transactions. This is the problem that Carlos feels that he's dealing with. And he wanted me to make sure, because we did a video about, I would say a month and a half ago, Nathan, about lending, because it was so big to IRA Club members. And they're still trying to figure out ways to either self-deal, use a disqualified person, or as I like to call it, a straw man.
Yeah.
So you either love Carlos or you hate Carlos. But for those of you that are trying to do any of these three things, I'm pretty sure you guys are hating Carlos at this point. But that's her job. As a full administrator, Nathan, you know that you know this better than anybody, because I'm sure that you deal with questions like this quite often. But a straw man seems to be the biggest thing right now. If you see that gentleman trying to hand money underneath the table, that is what constitutes a straw man. So hypothetical, let's just go first and foremost. You can never self-deal, all right, your own retirement funds. That's first and foremost. Carlos wants to mention that. 2, Carlos also wants to mention that you cannot lend money to a disqualified person. So who constitutes as a disqualified person? I want you to think of a ladder, right? There's me, let's say my spouse, my parents, underneath me, my children, my grandchildren. That also constitutes for my spouse. All the same rules that apply to me also apply to her. All right. Yeah. But what's funny is you could invest to your sister, to your sibling, to your uncle, to your best friend. That's where the straw man comes in, though. So why am I saying that to you? Yeah. A lot of people that try to utilize this tool or bend the rules will try to do this with Carlos. So hypothetical, let's just say I have a restaurant that I'm looking to invest in, but I can't use my personal funds. So what do? I lend the money to my sister to invest in the restaurant. That is a straw man. That will automatically trigger a prohibited transaction. You cannot do that. Many of you ask to do that quite often. The other thing, as I mentioned, and I'm not sure if I mentioned it during this recording, but in the very beginning, is if you are going to lend, we prefer that you lend. Most states will not let you lend, and correct me if I'm wrong, Nathan, at least at bare minimum prime, right? Prime, I believe right now, Nathan's at 4.75%. Yeah. So when Carlos asks, when you look to lend, make sure it's a percent over prime. Yeah. So, yeah, and we just do that for safekeeping and other reasons why is we also like to talk about the differences between, and I'm sure, Nathan, you're going to go into great detail about secured lending investments versus non. I'm not going to get into the weeds to this because I'm going to leave this to you as you being the experts, but I'm telling you what Carlos here is on a day in, day out basis. What constitutes as assets? What am I supposed to be asking these people? Well, some of the questions that Carlos will say is, well, find out how much money they have liquid, right? And if I were you, personally, me, Ramis Fakori, I would at least go back a bare minimum of 12 months. Carlos says 90 days, not me. I want to see what is going on for the last year. Mm-hmm. See how much is, if not within liquid, see if they may have other checking or savings accounts, right? The other thing that I also ask, personal versus business accounts. If they do have a business, right? What percentage of the business do they have? How much money are they in control of within that institution? That is another asset, another form of how they make money in order to pay you back. Retirement funds. How much do they have within their retirement funds? Stocks, bonds, gold. Many people right now are also investing in gold within their retirement funds. Mm-hmm. What assets do they own free and clear that could back the actual loan? If not, find out how much are they leveraging. So if they have a lot of debt against them, that could also trigger something that, Carlos would constitute as a risk. We're trying to minimize risk at the end of the day for you. So always, in my personal opinion, make sure that they have skin in the game, that they have assets that are maybe paid for free and clear, or they may have $1 million in equity that will feel like a good sign of protection. At the end of the day, nobody could determine that except for you. But if you're not sure if you're doing a prohibited transaction or not, ask. Call the IRA club. As a member of the IRA club, you have a point of contact here, right? Every single person, the beauty of IRA club is this true system of checks and balances. You ask if you don't know 100% for sure, right?
And you got to find out, because those penalties are stiff, and you don't want to fall into that.
And Nathan, I know I didn't want to get into too much of that, and I'm pretty sure you're going to jump into that, but why would you ever want to forfeit something that's generating you tax-free or tax-deferred income?
Right.
when Nathan's going to talk about 8% returns right now, it's not 8% returns when you're utilizing a Roth or even a traditional IRA. Mm-hmm. It's actually like 10, 12, 14, 16, depending on the longevity or how much you're investing. All right. That is huge. Yeah. So great way to protect yourself. Now, Nathan, I'm going to shut my mouth. As this is a recording, we're not going to be able to edit this. So be careful what you say. I'm just kidding. Actually, say whatever you want. Please educate people on the whole topic of, note investing a portion of your retirement funds, as it seems to be a hot topic of discussion. I'm pretty sure you firsthand are seeing this as I am stop sharing my screen, and I'm going to go ahead and make you now the host. Great. And give me 1 second more, and you are now the host, and please feel free to go ahead and share your screen.
Awesome. I will do that. Hey, thank you so much for the introduction.
Absolutely. It's all right,
exactly
buddy.
How we wanted this to go today, but
okay.
Just go with it. Just go with it. So I'm going to talk to everyone today about investing to make a difference. If you look at some of the most utilized and sought after types of investments these days, a lot of people are looking towards impact investing and something that's going to make a difference, something that's going to help change the world in some way. And I cannot think of a better way to do this for individual lives. So you can talk about environment, you can talk about some other parts of the world that we can help impact. This is talking about individual people, actual real people that we're helping to make a difference in their lives. And so I'm excited to share a little bit about all of this with you. Let me talk a little bit about myself. I did a very, very brief introduction before, but let me just go into a little bit more so you know a little bit about who I am. So I started in notes in 2010. That means just right after the crash, that's when I got started. And I got involved in non-performing notes. If you think back in time in 2010, there were a lot of non-performing notes. And what that means is somebody stopped paying on their mortgage. And then I would pick up that mortgage. And I'll talk a little bit more about that in a minute. But that's when I got started. Since then, hundreds. I've somewhere, I don't know, 300-400 loans, properties that I've dealt with in the meantime there, where we've done a lot. It's been fantastic. I have been around long enough, and I'm fairly well known in the industry, and so I'm actually able to get, when I compare notes with some of my colleagues, I think that I'm actually able to get below average pricing when I'm purchasing, and partially it has a lot to do with these key relationships. Like so many things, and more especially in this business, relationships are absolutely key. And it's so important to be able to have the right contacts and the right people and have good relationships with everybody involved in this space. And thankfully, I've been able to do that. And I'm quite happy about that. People generally, if you talk to other note investors and you talk about Nathan Turner, they'll know who you're talking about. I'm the Canadian note guy. I think one of the only Canadian people doing this. And like I say, everything I do is in the States. I just happen to live in Canada, but it created the moniker. So I have a website with that and everything. I actually quite like that. I recently took over a conference, the Diversified Mortgage Expo, and we're going to be putting that on annually. So the next one's going to be next June. Most likely in Nashville. So stay tuned for information about that if you're interested in going to a conference. And one of my key beliefs is treating people with dignity and respect. And that actually came from a book called Bailout Riches that I read not long after I very first got started. I probably read that in, it was probably 2010. And that's, it was written by a fellow named Bill Bartman. And he went even more risky, if you ask me. He passed on a few years ago, but he used to buy unsecured debt. So we're talking about like credit card debt, things like that. That's what he would buy, and then he would try to collect on this unsecured debt. I am not into unsecured debt. I very much like the security and the safety that I get having real estate properties, single family houses as my collateral. But that was one of the main things that I took out of his book. Is he talked about at one point treating people, I mean, I repeated it several times actually, but he talked about treating people with dignity and respect. There's no need to get nasty and mean. I've talked to people about what I do, and it's people have, from time to time, they say, so you're in the collections business? And that's not at all what I think. I'm actually much closer to a bank than I am to a collector, but there are times when I guess I'm asking people for money. So in some ways, I act as a collector from time to time, but really I'm a bank. And that goes right into what I'm talking about here. What is a note, and why am I a bank? So anytime you promise to make a payment to somebody else and it's written down, that is a note. So in our case, we're talking about mortgages, deeds of trust, contracts for deed. Contracts for deed go by all kinds of other names as well. Land contract, agreement for deed, bond for deed. They're all the same thing. And just for simplicity in the industry, we all call them all contracts for deed, or CFD for short. But if you think about yourself, you go to buy a house, you probably don't have that $500,000 needed to buy the house cash. You're probably going to have to go to a bank to borrow money to be able to pay for the house. The bank will then give you that money to be able to buy the house, and in turn they give you a mortgage and a note. And for our purposes, we're going to just call them the same thing, mortgages and notes. We're just going to say that they're the same thing. Technically they're different, but we won't get into that. It has the terms of repayment. It has what your payment amount is going to be, how long you're making that payment, what the interest rate is, all those kinds of agreements that you agree to. And then that is when that document is established. Where I come in is typically when people stop paying on their mortgage for all kinds of different reasons. There are some common threads in there, but suffice it to say, when people are not paying on their mortgage, I will then approach the bank or hedge fund or whoever owns that note. Sometimes it's just somebody did a personal deal with somebody on a second property they own. But I will approach that company and say, okay, so they're not making payments to you. I understand that's a problem for you. Let me see what I can do. We'll take a pause here just for a second, just to show the problem, I guess, that we're facing. This is a chart showing total amount of household debt in the United States. This goes up to the end of 2020. So it's a little bit old, but not much. We're missing about a year's worth of data. So since 2003, the total household debt has doubled. So we're talking about nearly $15 trillion of household debt in the United States. This is what that looks like. Mortgage debt, of that total debt, about 70% of that is household debt, is in your mortgage. And between 2000 and 2021, the average delinquency rate ranges somewhere between 4.2 and 9.3%. So people take out these mortgages. It represents a huge portion of whatever debt that they are carrying. And what we're seeing is that debt amount is increasing very steadily. And then there's a default rate there. Just for easy numbers, let's call it 5%. So every year, around 5% of people default on their mortgage, and they're not able to make payments for all kinds of different reasons. And then that creates problems. You got the banks that are holding these mortgages, and then that's a problem. So how do banks make money? They make money with interest and fees. They don't make money when people are not paying on their mortgage. They don't make money when people are not making payments, and then the bank has to do a foreclosure. Banks don't make money by doing real estate. They make money on interest and fees. So if somebody quits paying on their mortgage, that becomes a big problem for the bank. This is one that I saw early on, is banks have very, very narrow parameters. So when they say, we've lent you this money at this interest rate for this amount of time, they do not have a lot of wiggle room. It's very difficult for banks to be any kind of creative to be able to come up with solutions for people. Some of the very, very small banks, perhaps. Some of the credit unions, maybe. But by and large, banks just don't have the flexibility to go outside of whatever box they've set. They're also dealing with warehouse lines of credit. And what this means is where do banks get money to lend? They get it from these warehouse lines of credit. And what happens is, and we saw this particularly 2008, 2009, 10, when we had so many defaults back then, banks are only allowed to have a certain percentage of bad loans on their books. Once that becomes too high, the bank becomes insolvable, and it's not good. And so they are very, very motivated to get rid of these bad loans on a regular basis. We have not seen the same kind of default rate that we saw back in 2008. And I'm not anticipating we're going to see that level of default again anytime soon. But the fact is that those defaults happen, and that becomes a problem for the bank, and they need to cycle it through. At the very least, they need to get rid of this stuff. So they'll sell it off to hedge funds, they'll sell it off to larger investors, and then eventually it gets around to somebody like me. And this is where the impact investment investor comes in. The best definition of an entrepreneur that I've ever heard is somebody who solves problems for profit. And I think that is so applicable. That's really all we're trying to do, is we're trying to help somebody, we're trying to solve some problem and make some money at the same time. The beautiful thing with what we do is I'm not a bank. So when it gets to me, I've got all kinds of flexibility. I can do all kinds of creative things that the bank just can't do. Because they've got their set box and they can only do whatever's inside that box. I hardly even have a box. I can do all kinds of different things. There are some rules, of course, but we can get all kinds of creative and really dive down and see how we can help people the best. What a fantastic way to revitalize neighborhoods. It is so often that I will pick up a non-performing note, and I talk about non-performing. I buy both performing notes where people are making regular on-time payments, and I buy non-performing where people are not making any payments at all and maybe haven't for a couple of years. It's very common, even now, where I'll pick up a non-performing note on a vacant property where the people that were living in that house left for whatever reason. Maybe they passed away, maybe they decided they could do something better somewhere else. For whatever reason, the house is vacant. Vacant houses create problems for neighborhoods. So I'm able to go in there and buy the mortgage on the property, take back a property and sell it to somebody local who's going to fix it up and make it better and sell it to somebody who deserves it in the neighborhood. I love that this is all secured by real estate. When I read Mr. Bartman's book, he's talking about unsecured debt, and I think that is risky. That's really, really risky. You're spending money on something with no guarantee of getting it back and no way to ensure that you've got any kind of value there. What we're talking about is mortgages are always secured by real estate. So it's an interesting twist on real estate investing. And I love, love, love that this makes a real impact on people's lives. It happens all the time where we get somebody that can't make a payment because whatever, they lost a job or they lost a spouse or something like that. Now they're back on their feet and they're ready to make payments. Maybe they couldn't do that payment at $800, but they can do a $600 payment. And that's something that I can go in and say, that's no problem. Let's do that. We'll work with arrears. We'll work with their interest rate. We'll work with their payment amount. And we can really help people to be able to stay in their homes, to have a better quality of life wherever they are. And that feels good. It's nice to be a part of that. When I talk about flexible, this is just kind of an example of that. This is something we came up with here, a few years back, but the point of it, and I don't want to get too much into the weeds here, but the point of this is just to show all of these green little oval things at the end all represent some kind of different exit strategy. So when we're talking about being secured, this is what we're talking about. When we're talking about being flexible, this is what we're talking about. We've got all kinds of ways that we can continue to make money on this and help people at the same time. And that's really, really nice. We can help people to get refinanced. I'll share an example of that here shortly. And We can hang on to it for long-term cash flow. We can sell this note off to somebody else. We can foreclose and then sell that house to somebody else in the neighborhood that can take care of it. But there's all kinds of different things that we can go through and different ways that we can pivot if and when we need to. And that helps increase that security and ways that we can help people out. So I wanted to show just a couple of examples here, and I'm giving kind of a high level because I don't want to take up too much of your time, but please feel free to reach out to me, and I'm more than happy to go over different ways that this works. But here's just a couple of examples. Here's a property, Jessup Street, out in Delaware, and part of the row housing that is so popular in the New England area. But this is this lady living in this property. So she had signed a lease option contract. And what that means is she was paying as if it was rent. A portion of her payment every month was going towards the purchase of the property. And after, I think it was 3 years, she was expected to pay off the rest of the loan. And in that way, she was going to be able to buy the property. Of course, what happens is that 3 years comes around, she doesn't have the money. So I bought this note. First thing I noticed is with the percentage or with the money that was being taken off of her payment to go towards the principal, to go towards the purchase of the property, the interest rate was the equivalent of about 11%. So it's a pretty high interest rate. I was able to talk with her, and we were able to figure out that we could do things better for her and help her save some money. And we converted this to that other kind of contract I mentioned, a contract for deed. And we're actually able to lower her interest rate. At the same time, we're actually able to lower her monthly payment. So she was able to save $15 a month. I know that doesn't sound like a whole lot of money, but it's a lower payment than what she was paying before. Just to give you some really quick numbers on this. So I bought the loan on the property, not the property itself, but the loan on the property for $35,000. And with the new terms that we negotiated with this woman, I was able to have a yield or an ongoing return of 16.5%. So that works out really, really well. So just to explain that a little bit, the balance on the loan was about 50,000, 55,000, somewhere in there. I was able to give her a 9% interest rate at her new monthly payment, saving her $15 a month. And because I had bought it at a discount, because I had only paid $35 for it, that's how I get that yield of 16.5%. So that works out great for everybody. So the question is, well, why would you do that? Why would you take less money and do a lower interest rate if she was already paying at the higher interest rate? A couple of things. Number one, a contract for deed. If I choose to sell that loan sometime in the future, it is much easier for me to sell a contract for deed than it is a lease option contract. And then for her, it provides her all kinds of more security under that contract for deed. Now she's getting tax credit for that as well, besides saving the money, besides having a lower interest rate. So it really is a win-win-win all the way around. So I love that kind of a deal, and that's not uncommon. That's the kind of thing we do all the time. Let's look at one where it was a non-performing note, and then I sold it on terms. So here's what I mean by that. This one is Green Drive. This is in Mississippi, and one that we just finished recently. So completed this foreclosure. It was a vacant property, so that we had clear titles to the property at that point. And then we put it back out for sale and offered terms. So rather than somebody having to get a loan from the bank, they could get terms, whatever terms they might be able to get from a bank, they could get that through me. Oftentimes they will do that because maybe their credit score isn't high enough or something else. Maybe they're self-employed and some other way where they're not able to qualify with the bank. Because of that, I do take some advantage in that where I will charge a higher interest rate. And I think I feel good about that. I feel that's fair because they want to be able to own the house. I'm helping them to be able to own a house in this way. So we're able to sell this to this wonderful woman. I purchased the loan on this for $67,000. Had a little bit of expense with the foreclosure, not a whole lot. Here's the terms that I sold. So she approached me and the realtor, and she said she had $25,000 to put down. The sale price on this was $90,000, so she paid $25,000 down payment. We wrote this at a 10% interest rate over 15 years, That's her payment amount there, just under $700 a month. And again, because I was able to get this at a discount, because I was able to buy it on sale, we ended up with a yield of 17.19. So the yield, just as a quick explanation, what that means is for the next 15 years, over the life of that term, I will be making 17.19% per year over the life of the loan. Not bad. I'm quite happy with that. And we're able to help this woman out, and she's living in the house and making payments, and she's great. Let me show you one more here. It's foreclosure. And we sold this house to a local. So this was kind of a fun one. This is in Tennessee, Ridgeway Avenue. You'll see there that little orange sign that says no trespassing. Here's how that came to be. The woman that was living in the house, this is another vacant property, completed the foreclosure, and the deadbeat grandson was crashing at the house and making a mess and being a real nuisance to the neighbors. So it was actually the neighbor that I spoke to, and I was in very close contact with him all throughout the foreclosure process, and then thereafter until the property sold. The neighbor is the one who actually put up that no trespassing sign. He was the one that cut the grass. The neighbor is the one that I spoke to at least once a week while this was all going on, and helping him help the neighborhood. And the whole neighborhood couldn't wait to get rid of this deadbeat grandson that kept coming around. And so that worked out very well for them. So we completed that foreclosure. The neighbor helped take care of the property all throughout the whole process. And then a local investor is the one who bought the property. He's going to go and fix it up and sell that for whatever he's going to sell it for. We bought this loan, 28.5, sold the property for 45,000. Overall return on investment on that's 28%. Again, that is not bad, and we're helping to revitalize the neighborhood and keep it up and help people all at the same time. So here's the beautiful part: is how do you get involved in all this, and how do you help people? Earnest Investing LP is my company. So we actually created a fund just at the end of last year. So I am raising capital for that fund so I can continue to go out and help people and revitalize neighborhoods and help people stay in their homes and keep doing what I love to do. This one actually is, because it's a registered fund, it is only open to accredited investors, unfortunately. I wish that could be different, but that's a matter for the government to figure out. This is a 5-year term, 8% preferred return. They pay that out quarterly. Minimum investments, 50,000, maximum $1 million. And the beautiful thing, like Ramaz was saying, is you're doing this all in your IRA. So you are acting as a lender, lending my company the money for an 8% preferred return, knowing that you're helping people and knowing you're helping to revitalize neighborhoods all at the same time. So I'm asking you to help me to help others and get involved in that way. This is my contact information. I would love to talk to you some more about this. I know I went over quite quickly and somewhat briefly about the business, but the point I hope I'm driving home is this is a fantastic investment for your IRA, and it's a way that you can help other people without lifting a finger.
Nathan, thank you for the complete breakdown on what it is that, Earnest Investing does. So I hope it all made sense to everybody and how he utilizes this fund to generate and utilizes, IRA funds or your own personal funds. Please forgive me. It doesn't matter.
Absolutely.
It doesn't have to be IRA funds in particular, but how he utilizes it to, well, number one, make neighborhoods better. He creates his own he uses your money to lend in order to create these amazing ROIs in order to provide your 8% return on investment. So Nathan, I'm pretty sure, I know this is a recording, but the $1 million question many IRA Club members are probably asking, why aren't you doing this in Canada? Why the US?
It's so interesting. Our two countries are very, very, very similar. When it comes to banking, we're not.
When it comes to, very true.
We're very close. Very quick example. So anytime you buy a house in Canada, 90 to 95% of the time, there's a government agency called the CMHC. They guarantee the mortgage. So in case of default in Canada, that CMHC kicks in and provides insurance to the bank. So the bank really has no incentive to sell off the loan at all. So it just doesn't, the market just simply does not exist.
Understood. Makes sense. Did not realize that.
Yeah.
Let me ask you another question. Talk a little bit about risk. Like, what kind of risk is involved in some of these projects that you're jumping on?
So here's the interesting thing with notes. If you think, one of the things that kind of took me a little time to get my head around, because I came from a real estate background, like a lot of people, is we're talking about owning a loan instead of a property. And what that means is I'm the bank. So if you think, as the bank, banks don't fix roofs, they don't unclog toilets, they don't paint houses, even they don't change the flooring, they don't deal with all of the things that a typical landlord would. So our risk is actually really, really minimal. The time where our risk actually increases is when we take back a property. And it's at that point where if it's ever going to go sideways, that's when it goes sideways, is when we take back a property. So we, in the fund, we buy multiple assets. We've got like 100 different loans that we're purchasing. Some of those will turn into property. A lot of them will not. And most of them won't. So we're taking on a small piece of potential risk that's spread out all throughout the whole fund. So if one goes bad, it doesn't really affect the rest of the performance.
And I'm sure another question is going to be skin in the game.
Yeah.
Do you personally have any skin in the game with some of your, maybe not all of them, but some of them?
So here's what I've got. I have my own personal portfolio of loans.
Got it.
And then my skin in the game is this is my livelihood. This is my 100%. I don't have a part-time job. I don't have a full-time job. This is it.
Okay.
Yeah.
This is it. Well, you heard the saying, Warren Buffett says, never do business with anybody if they don't have skin in the game, right?
Yeah.
What they don't love to do on a day in, day out basis. I could tell by your smile that you're so very much into what it is that you do. But you mentioned the word helping communities. I've seen it firsthand where such, funds like yourself will come in. The ROI is there, but what they don't also realize what they're doing is they're, changing the neighborhood for the better. So you're taking a nice portion of whatever it is that you're raising into making, the neighborhoods better at the end of the day. And you say an 8%, nothing is guaranteed, but is it a deferred?
Yeah. It's funny when you talk about disclaimers and all that kind of thing.
Yes, that's why I like saying that out loud.
And they say, okay, here's some things you can't say. I'm like, okay, so guaranteed is on that list of things I can't say. So
can't say that.
I can't say that. What I can say is we pay out 8%.
We pay 8%.
We pay out 8%.
I'm just saying that to people out loud because 8% right now seems very appealing. Let's say if you have an old employer's 401k or an IRA sitting in the market. Mm-hmm. Picture this, you just lost 27%. And then on top of that, inflation's at 8.56%.
Right.
You're basically down almost 40%, your retirement portfolio.
Yeah.
Why not think about protecting or use a portion of your retirement funds to hedge and protect yourself against the volatility of this next, year, 2, 3, who knows? I don't think inflation is going anywhere for the next 3 to 4 years. This is me speaking personally. At least it's probably going to hover around 5 to 6%.
Yeah.
Even if they try to get some of it under control. The majority of your the fund itself, how long are the terms? You said, and maybe I might have missed that. It was
this one's a 5-year term.
5-year term.
I think it's a great time to park it there, take it out of the stocks if that's where you got it, and avoid that roller coaster.
Exactly.
Get it to where you know where it's going to be.
100%. Now, although I apologize to everybody, this is a recording and you can't personally ask the questions that you want to ask. Get a hold of Nathan. All right. Actually, Nathan, if you want to share your screen and just pop up your contact information one more time, although they probably already received it, I just want to make sure that everybody, there you go, sees that. He has a 312 number. Although he's in Canada, he's got a Chicago Chicago's 312. That's why I'm smiling when I saw that earlier. That makes me laugh. But anyways, yes, please feel free to reach out to Nathan. Remember, what IRA Club does and offers and provides is administrative work, right? We take the control away from one of the other 10,000, companies or brokerage firms or annuities, and we give it back to the investor, right? Yeah. And then what we do is what you do is instruct us, because now you're in control to invest in different types of asset classes, this being one of them. Yeah. And again, you are dealing with an accredited investor, right, Nathan? Minimum investments typically are?
This one for mine is 50,000.
50.
And then maximum is $1 million if you've got more that you want to throw in there. Got it. I wish that I could have gone a different route and not had to exclude a bunch of people, but I don't make those rules, unfortunately.
Yeah. Well, unfortunately, yes, that's what the SEC is to generate those rules and regulations. Again, I thank everybody for their time. If they're listening to this recording, Nathan, I'm sorry. I know me and you couldn't get that whole, link to work live. I hope that you receive a few phone calls. Again, there is Nathan's email personally if you want to reach out. If you want to reach out to the IRA Club or you'd like to schedule a call, feel free to go to our website, also top right side. Although we cannot talk about investment opportunities, and if you just have any general questions, maybe about what are the next steps when it comes to investing within Earnest Investing, please feel free to reach out to us. Again, I hope this was educational. Nathan, thank you for your time. I always like giving the last word to our guest speaker. Is there anything that you want to close with before we let our IRA Club members off and enjoy the 4th of July weekend?
It is 4th of July weekend. I wish everybody the best for the 4th of July weekend. Hopefully that's a fun time, and it's a time when finally, for the first time in a couple of years, everyone's able to get together and
very true,
be part of friends and family, which is fantastic. Get involved. These IRAs are such a fantastic vehicle. Get involved and do the self-directed. That's what it's there for. And you can choose. You can choose how you want this to go.
I do want to I'm going to cut you off with a closing cost, because you said use these self-directed IRAs. Please be wary of this. Okay. A lot of the new term that we're seeing within the Fidelities, Vanguards, and Schwabs, and one of these other 10,000 brokerage firms is now they're utilizing self-direction as a marketing term for them, where they're saying, hey, guess what? You don't want to deal with stocks, bonds, mutual funds, and ETFs. You could go ahead and invest. We'll give you self-direction to invest maybe in a REIT or whatever else that they're wanting to. But just keep in mind, you still are tied into the investment opportunities within the brokerage firm. Right. That's not true self-direction. Right. So if you have a fiduciary or for a financial advisor, and some of them just may not understand the rules and regulations, ask them, can I invest in, Earnest Investings? I found this great investment opportunity. If he says no to you, cut him loose, him and or her. All right. That's not self-direction. But again, they're supposed to be working out for your best interest. And truth be told, they just may not understand. Nathan, again, thank you. And thank you for everybody that's joining us for this recording. Feel free to reach out. We are going to be having a live event, Nathan, here, not this Saturday, but next Saturday. We're going back to live events. Feel free to go to the IRA Club website, go to the events page. You could register. You could visit the IRA Club offices. It's within our building in between Michigan Avenue and Wabash, kitty corner to the Bean at Millennium Park. We're super excited about that. All right, Nathan, it was a pleasure, buddy.
Hey, thank you.
Thank you. Be safe.
Bye now.
You don't have to. 1 second. Stop recording.